Good morning. Today is Tuesday, the 4th of October. I am flying solo today. Tom and Andrew are actually speaking at a conference down in downtown Atlanta. Tom's going to be talking about fixed income in a low interest rate world, which isn't so low interest rate anymore. He's going to be on a panel with a guy who's talking about mortgages and potentially seeing some buyers come back in the market on mortgages. And then Andrew's going to be talking about organic and inorganic growth strategies for firms just like ours. So pretty interesting. I'm curious to see what they have to report back from other speakers when they get back tomorrow. So we'll be addressing that tomorrow. Quick programming note, next Tuesday, October 11th at 4:30, we will be having our fourth quarter macro presentation hosted this time at Marietta Country Club. So please be there if you can make it. Just let us know beforehand. It's nice to have a quick idea of head count. But again, that's 4:30 p.m. next Tuesday at Marietta Country Club over in Kennesaw. So a different location than previously. It will be simulcast on Zoom. If you would like a link for that, we can send that out also. Getting into the meat of the call this morning, we have ISM Manufacturing that came out yesterday. So ISM Manufacturing is a good proxy for where GDP is, at least in the manufacturing side of the economy. Typically, anything above 45 is considered growth territory. Anything above 50 is solid, decent growth. We have been in the 60s at times during the recovery. Yesterday, though, we were at 50.9, which was definitely lower than expected. It was also down from a 52.8 reading in August. And that was driven by a number of factors. Number one, new orders were down to 47.1 from 51.3. Employment was down to 48.7 from 54.2, which is a bit surprising to me because I definitely wasn't anticipating the decline in employment in manufacturing, given what has been an uptick in overall economic activity over the last couple of months. And then pricing also fell down to 51.7 from 52.5. For context on prices, this was having readings north of 80 just a few months ago. So to only be at 51.7, barely getting any pricing growth on a month-over-month basis, that is quite significant and should embolden some Federal Reserve members, for instance, to have a little bit more of a sanguine view to where inflation is going. Whether or not they actually look at this data and abide by it is another question. We'll get to that a little bit later on. The reads from here is that the manufacturing side of the economy is decelerating a little bit. It's not yet in contraction territory, but people have quite a bit of inventory and they don't want to have so much inventory because they are scared of what could be a more significant recession coming up. So on the chemical side, this one person who was interviewed said that there are concerns of a global economic slowdown, and we are experiencing some customers pulling back orders. In fabricated metal products, that people are saying business is flat to down, and it's still hard to find and keep employees due to wage increases by competitors. And finally, on the machinery side, which is probably the most interesting from a business investment perspective and could play into the GDP result ultimately for the for the third quarter, it is that supply chain constraints are still an issue. Staffing is still a problem. But overall, they have more inventory than needed on some key items, especially on the import side, and, quote, have begun reducing open purchase orders. So again, the new order side of the manufacturing economy is slowing because people already have inventory. We saw this with Nike results, actually. They got a lot of inventory. They pre-bought a lot of inventory, which actually ended up arriving. So now they have a lot of inventory that they need to work through over the next few months. So this is also feeding into pricing, which is coming down just a little bit. And I think it does. This is just one data point, and I don't want to read too much into one data point, but we could start to see some of this filtering into the overall economy over the next few months, which I actually think would be a fairly bullish sign, because that would suggest that the Federal Reserve might take its foot off the brake just a little bit in terms of raising rates aggressively. Again, it's just one data point. Inflation is still an issue. And we do have the oil situation with OPEC potentially cutting well north of 1 million barrels per day. And then also the SPR releases that'll be fading away by the end of the month. Nevertheless, I think that this is one good data point, and it helped to catalyze the market rally yesterday. Upcoming data this week. Today, we have the number of job openings. That'll be out at 10 a.m. Remember, the job openings continue to be extraordinarily elevated, which is feeding through into wage inflation. When you're trying to hire people, you have to pay them more in order to attract them, and that's creating some more inflation in the economy. So we have the job openings or data later today at 10 a.m. A lower number would be good for the markets, I think. A higher number would continue to put pressure on the Fed to raise interest rates. Tomorrow, we have the ADP employment number. That's going to be, I just don't think that's going to be a market mover because they changed their algorithm and no one really believes it right now. But we also have ISM services at 10 a.m. So we'll be keeping a keen eye on that. And it all leads into the Friday employment report, the non-farm payroll report, where we get the actual number of jobs created or lost in the month of September. So a lot of data coming this week. We get all of this heading into Tuesday's macro presentation. The Fed meeting, the emergency Fed meeting yesterday, there was really nothing to report from that. There's no news items on that. There's no Wall Street Journal items on that. But I would say that we are beginning to see, akin to what we're seeing in the manufacturing side, where pricing is coming down just a little bit and inventory is elevated. We're beginning to see central banks turning the corner on their hawkishness. They're beginning to be less tight, not dovish, not easy, but less tight. So we talked about the Bank of England deal last week and yesterday. The Bank of Australia raised rates just 25 basis points today. They were expected to raise about 50 basis points, but they only did 25 basis points. In fact, they were the first major central bank to raise rates by a quote unquote normal amount. And that they say, and I quote, "The cash rate has been increased substantially in a short period of time. The board remains resolute in its determination to return inflation to target and will do what is necessary to achieve that." But at the end of the day, they raised rates by less than expected and by less than what they had done. And so for people thinking that the central banks are about to turn the corner and that they're shifting from this era of really, in our financial market memory, pretty unprecedented monetary policy tightness. They're shifting from that to a more normal type of monetary policy tightness. And I think that is a good sign for the markets. And I think it catalyzed yesterday's 2.5% rally in the S&P 500 and this morning's 1.5% rally in the S&P 500. And by the way, the NASDAQ is actually up a little bit more than that this morning. Commentary from the Federal Reserve itself, New York Fed's John Williams says that we still have a significant ways to go in terms of raising rates. But he did make note that there was a decline in activity in the housing market and signs of slowing in the consumer and business investment spending, which fits with that ISM manufacturing data that we got yesterday. And he says, and I quote, "As this continues, I expect real GDP to be close to flat this year and to grow modestly in 2023. He said that while getting inflation turned around is a priority, the speed at which we do those actions will be driven by the data and how the economic situation evolves." Well, the data that we got yesterday would be suggestive of a more normal type of interest rate program. So I would not be surprised to see, assuming inflation does decelerate a little bit in terms of the reported numbers over the next couple of weeks, when the Fed meets in early November, I would not be surprised to see a little bit of a smaller interest rate increase at that time. Again, it is predicated on data confirming what we saw from the ISM manufacturing report, but I am increasingly of the view that we're shifting from this really unprecedented monetary policy tightness to a more normal level of tightness. Again, not easiness, but more normal tightness. And I think that that'll be good for the market. So what does it all add up to? It adds up to nice relief rally in markets. It adds up to lower interest rates, which means higher bond prices. So portfolios went up yesterday. They're looking like they'll go up to today. And I would caveat all of this by just saying that just because inflation is going down doesn't mean the economy is reaccelerating to the upside. We saw a nice pickup in August and September, but to think that this is now going to all the problems are solved, the reason inflation is going down is precisely because the economy is not in a great spot. So, it's both hands of that scale. So that's something that we're going to be talking a lot about on Tuesday. It's beyond the scope of really talking about in a morning call, other than just to make sure everyone's aware that it's a two balanced situation. So with that, I'll leave it there. Tomorrow we'll have Andrew and Tom back. We'll recap their conference. We'll talk about the ADP employment report, preview the ISM manufacturing report, ISM services report, talk about the job openings, and then look forward to the employment report on Friday and the Fed's decision making from that point on. Thanks for joining us, and we'll see you tomorrow morning.